So let's start this session over here. It's related to the liquidity risk management. Now, what is actually the liquidity? Let's take the case that the bank is having the funds of amounting 100 crores over there, and the bank is to pay 90 crore over there. It's a positive gap or negative gap? Definitely it's a positive gap. How come it is positive? Because the inflows, the bank is having the inflows greater than that out of the cash outflows over here. So whensoever we are having the inflows, cash inflows greater than the cash outflows, it's a positive gap over there. But what's the case when we are having the cash inflows lesser than that of the cash outflows? In that particular case, we are basically out of funds, because that basically signifies what? That we are to pay. Let's take the case that we are to pay 100 crore rupees and we are just to receive 90 crore rupees. We are just assuming the amounts over here. Now in this particular case, the cash inflow is lesser than that of the cash outflow. That's particularly a very serious condition, because we are to borrow the funds from the market, and it may be the case we not be able to get the funds at a reasonable cost over there, and that's actually the liquidity risk over there. So bank is said to be solvent. It may be the case the bank is solvent, but still the bank is having the liquidity risk, that the bank is not able to meet up the liquidity obligations on the bank over there. So that can be the case related to it. Now let's understand the case that what the bank status can be. The bank can be the solvent and the bank can be the liquid also. So just have a look at over here. Just look at the 4 points over here, that the bank can be both the solvent, and it may be the case that the bank is having the sufficient liquidity. It may be the case that the bank is liquid but the bank is not solvent, that the bank is having the liquidity with it, that it can pay off its obligation, but the bank is not solvent. It may be the case. It may also be the case that the bank is solvent but bank is not having the liquidity, and it may also be the case that neither the bank is solvent nor the bank is having the liquidity. That the 4 scenarios can be there. It basically means what? That case could be the bank is solvent but not liquid, the bank is solvent and liquid, the bank is not solvent and liquid, the bank is not solvent and not liquid. So these are the 4 scenarios which can be there. Okay, now what are the key consideration in particularly related to the liquidity risk management? Because we are to manage the liquidity. Now what is basically meant by the cash inflows over there? Now let's say the case there is a maturing deposit. It's a cash inflow or cash outflow? It's a cash inflow or cash outflow? Definitely it's a cash outflow. Why it's cash outflow? Because when the deposit will mature, then the bank has the obligations as to pay back that particular deposit to the depositor over there. So that's particularly the case of what? It's a cash outflow over there. And whensoever we are having the maturing assets, like you are having basically extended a loan, and particularly there will be repayment, you'll be going to receive the repayment of the loan over there. In that particular case, it will be cash inflow or cash outflow? It will be the cash inflow in this particular scenario. It will be the cash inflow in this particular scenario. So that's the case related to it. So repayment is particularly when you're going to receive the repayment of the loan. It's particularly cash inflow. Now when cash inflow is greater than cash outflow, then that particular case is positive gap. It's a positive gap over there. The gap is there, but definitely it's a positive gap. Still favorable. Still it's not required. We are to maintain the assets in such a manner that we are having a very low gap in between the assets and liabilities over there, maturing assets and maturing liabilities over there. But the gap is particularly, still this gap is not that much serious. Okay, but the case when the cash inflows are lesser than that of the cash outflows, it's a serious concern. Why? Because it's a negative gap. It's a negative gap. The bank is not having the liquidity. The bank is to borrow the amount from the market itself. Okay, so that's the case of the negative gap over there. So let's have a look at the key consideration for the liquidity risk management. First of all, it's related to the particular asset liquidity must be there. You must be having the sufficient assets with you. So liquid assets with you, which actually you can the liquidity from, and further you can pay off your liquidity obligations over there. And particularly the extent of the volatility of the deposits. Now it's the case that you're having the 100 crores of deposit, and let's say the case the 60% of the deposits are volatile. 60% of deposits are volatile, that the people can take out the money, over there. So that's particularly the point to be considered, because that's not required at all. That's a negative point. And further, we must not be relying much more on the volatile part of the deposits over there, because if you're relying on the volatile part of the deposit, it may be the case those deposits won't last longer over there. And moreover, you must be having the diversification of the sources of funding. It shouldn't be the case that the diversification is not there and you're having a single depositor. that you are having the single depositor who has actually deposited 500 crore rupees with you, and you're basically relying upon the same person only. That should not be the case, because it's not the diversification. But because if this particular person withdraws the amount, whole of your system will not be lasting there for longer. Okay, so that's the case related to it. And also you will be considering the historical trend, that what was the historical trend, that what was the demand of the stability of the deposits related to that. And also we must be looking for the quality of maturing assets, because maturing assets is a source of funds. It's a source of funds. So if you're not having the particular good assets, it means you're not going to receive the funds over there. You'll not be receiving the funds, and definitely it will also lead to the add to the liquidity risk over there. So you must be looking for the quality of the maturing assets over there. And definitely market reputation also matters. Like if the bank is not having the market reputation, the public will not be having a trust in the bank over there, and they will start basically withdrawing the money out. Okay, and that should be basically not be the case over there. And moreover, availability of the undrawn standbys, that you must be having some backup with you. If that is required, you can take some step, and further you can take back some amount from there, the case, and that should be the case. Okay, so these are the things you must be looking for. And other than that, it's a case of the impact of off balance sheet exposures. So you must also be looking for the off balance sheet exposure. Now, first of all, let me just tell you that we are having the balance sheet, we are having the liabilities on one side, we are having the assets on one side. Now that's quite feasible, that's quite viable, that we are having these assets and these liabilities over there. But there are some liabilities which are actually contingent in nature, that they can actually be crystallizing in the future. In the coming future, it may be the case that they could be crystallizing. Now if these particular liabilities will be crystallizing in the future, definitely there will be a requirement of the liquidity, because when these contingent liabilities will be crystallizing, definitely there will be outflow. Let's say the case that the bank has actually given a guarantee in the name of person A, okay, and further the condition which was to be met by person B, okay, the condition was not met by the applicant over there. Now the bank is to make the loss good, and there will be liquidity flow from bank to the beneficiary over there. Now this is particularly, the bank guarantee is particularly what? It's a contingent liability, because there was no direct outlay of the funds over there, but at a later stage the bank has to pay the amount, and that will actually cause a liquidity issue to the bank over there. Okay, so that's a case. And definitely contingency plan bank must be having. Now if there is a shortage of fund, how the bank will be actually be coming over the same. So that's a case related to it. So these are key consideration that the bank must be looking for. First of all, availability of the liquid assets over there, volatility of the deposits over there, degree of reliance on the volatile deposits, diversification, historical trends over there, quality of the maturing assets, market reputation, and undrawn standby limits over there, impact of off-balance sheet exposures, and the contingency plans over there. So these are the key consideration in liquidity risk management over there. Now let's have a look at the issues while managing the liquidity. Now what are the issues the bank may be facing while managing the liquidity over there? First of all, it's related to that you must be having an idea that what extent of operational liquidity is particularly being required by you, and particularly what the reserve liquidity is to be maintained, what is the contingency liquidity that is actually required. So you must be looking for the fact that what is the liquidity actually that is required. Now you can get an idea from the risk profile of the bank over there, and from the historical data over there. And also you must be looking for the impact of the market change. Now if the market changes this much and the liquidity demand changes this much, you must actually be maintaining the liquidity as per this particular scenario. Okay, so that's the case related to it. And also you must be having the availability, accessibility, and further at a reasonable cost of the liquidity. So you must be having the availability and accessibility at a reasonable cost. It shouldn't be the case that you require some extra or surplus liquidity and you have to pay a way more than the market price over there. So that's not actually required over there. So you must be having the funds available and also accessible, but at a reasonable cost over there. And also there must be the existence of early warning signals over there. Now what is the early warning system? Early warning system is particularly related to that there is a particular some level that we are going below some particular level over there. Okay, and further there must be early warning signal that this is actually the mark and beyond which you may face the liquidity risk over there. So there must be the early warning systems which actually be facilitating the prompt action prior to the surfacing the problem. It shouldn't be the case that the problem will surface only then we will be looking for the solution, looking for the remedy over there. So we must be having some system that we can get a early warning signal that yes, this particular thing is going to happen, now you have to take the action. Okay, and also there must be the efficacy, sufficiency of the processes, that particular successful execution related to whatsoever the solution required for managing the liquidity risk, that must be taken in time over there. So these are the issues while managing the liquidity and how these can be looked into. Okay, then further it's related to the potential liquidity drivers over there. Now there are two factors that we are going to consider. First of all, it's related to the internal banking factors, and the second one, it's related to the external banking factors over here. Okay, now there can be the internal factors and there can be the external factors which actually do signify that definitely the liquidity risk can be there. Okay, like if you're having a very high potential or very high number of the off balance sheet exposure items over there, definitely it's an internal factor. And also if the bank is relying heavily on the short term corporate deposits over there, or say the wholesale deposits over there. Now what is a wholesale deposit? That from the XYZ firm you have received 500 crores. Okay, so that's particular word, that's a short term corporate deposits, and if you're heavily rely on the same, definitely it can be the issue related to liquidity risk, because diversification is lesser over there, and definitely the deposit is there for a very shorter period over there. Okay, so that's the case. And also if there is a negative gap means what? When the cash inflows are lesser than that of the cash outflows over the particular time horizon. What do you mean by the particular time horizon? Let's take the case that we are considering the time period for 1 month only. We are considering the time period for 1 month only, and for this particular 1 month period, we are considering the effect of the maturing assets and maturing liabilities over there. Okay, that's particularly related to what? There is a negative gap related to what? There is a negative gap related to the particular time horizon. So that can be the case, and for that should be avoided. If that's the case, that can lead to the liquidity risk over there. And for the banks are rapid asset expansions over there, like the case that you are having a very limited funds with you, but particularly you are depending upon the borrowing, and further you're basically expanding your assets again and again at a very rapid pace over there, then definitely it can be the issue related to liquidity risk. And further, if there is concentration of risk is there on the short term tenure, definitely it will lead to the liquidity risk over there. Already told you related to diversification factor. And further, if the allocation is lesser, if the allocation is lesser in the liquid government instruments, definitely it's the case that you're having a very lesser liquid assets available with you, and definitely in the time of stress period, it can cause a very major factor to you. Okay, and further it's related to fewer placement of the funds in the long term deposits, that you are particularly not actually be depending, or particularly not relying on the long term deposits that much, and you're depending that much on the short term deposits, that can also lead to the liquidity risk positions over there. Okay, so that's the case related to the internal factors. Now let's have a look at the external factors. Now first of all, if your liquidity is very much sensitive to the market depositors, like the case is that the market interest rate increased by 1% and your liquidity factor basically affected by 20%. Okay, 20% it is affected. So that's the case. That's the case related to that your liquidity is actually quite sensitive. It is quite sensitive to the market position. Definitely that's not required at all. And further, there can be the internal or external economic shocks, like there is a stress period, and definitely in the COVID period, people basically started withdrawing the amount from banks over there. So that's the case that can be there. And further, it could be related to slow and low market performances, like your economy is not performing at all. How can you be maintaining the liquidity with you? Because the people will be requiring much more funds with them. Okay, so that's the case related to it. And also it could be the case that if the depositors are having lesser trust in the banking sector over there, definitely that will lead to what? That they will be withdrawing the funds over there, like the case happened in the case of the Yes Bank over there. Okay, then it's also related to non-economic factors can be there. The non-economic factors which can lead to what? Which can lead to that let's take the case that can be the particular point, like there is political stress or something else related to it, that can also lead to liquidity positions and the liquidity risk over there. And further, if there is a massive liquidity withdrawal, like in any of the cases I told you, due to the trust issues with the banking sector or something like that. Okay, so that can also lead to what? That can also lead to the liquidity risk in the banks over there. And further, if there is unplanned termination of the government deposits, like the government deposit, you were already being relying on the government deposit, but there is termination related to the same, that can also lead to what? That can also lead to the liquidity positions over there. Like you were having a government deposit amounting 500 crores or 5,000 crores or 50,000 crores, and government basically terminated the deposit over there. Now you have to pay 50,000 crore to the government over there. That can also lead to the liquidity risk with the bank over there. Okay, so these are the internal and the external factors. The next one is related to types of the liquidity risk. First of all, it's related to funding liquidity risk. Funding liquidity risk is particularly related to what? That whatsoever the expected and unexpected current or future cash flows are there, you're not able to meet up those obligations over there. Okay, so that's the case related to what? That's the case related related to the funding liquidity risk over there. Now what's the definition? It's related to whatsoever the current or whatsoever the future transactions, whatsoever the current or whatsoever the future cash outflows are there, particularly you are not able to meet up that particular obligation over there, and that's the case that you do require the collaterals, and further you basically need to borrow the money so as to particularly cater the proper function over there. So this is actually related to what? This is actually related to the funding liquidity risk over there. The next one is related to the market liquidity risk. Market liquidity risk is actually related to what? That it may be the case that you are having some asset or you're having a position in the market over there, but you're not able to offset that particular position. You're not particularly able to offset that particular position in the market over there. You're not able to particularly eliminate that position. You're not able to scare off that position in the market over there. So that's the case related to what? That's the case related to the market liquidity risk over there. It could be due to the market disruptions. It could be due to the lesser liquidity in the market over there. So that's the case can related to be. Okay, so these are the types of the liquidity risk. And also in the BCBS fundamental principle for the management of supervision, there are some principles given on the same behalf, so we'll be going through those principles over here. So here we are having the 13 principles related to the same. You need not to cram these principles over there, but you must be having an idea related to the same. So first of all, it's particularly on the board of director level. Why board of director level? Because each and every risk which is actually there in the banking sector, that the ultimate responsibility is with whom? The responsibility lies with the board of directors over there. The ultimate responsibility lies with the board of directors over there. So the board of directors must be having a policy in the bank over there which must be robust related to management of the liquidity risk, so that the bank must be maintaining the proper assets, proper liquid assets over there. The bank must be having internal limits, or we can say tolerance limits, related to the maintenance of positions over there. The bank must be having the access to the unencumbered assets over there, so that in the case of need, the bank can actually be dissolving that particular unencumbered assets and particularly can be generating the liquidity with them. And also the supervisors must be having the access of adequacy related to, they must be knowing, the regulators must be knowing if the bank is having a particular liquid position or particular liquidity or actual excessive liquidity with them, adequate liquidity with them, so that they can be managing their operations over there. And further, if the bank is in a deficient position, in that particular case, a prompt action must be initiated. So as to protect the depositors, and further so as to limit the potential damage of the reputation of the bank over there. Okay, so that's the case related to principle 1. Okay, so it covers board of directors, it covers the supervisors, and it covers the prompt action plan over there. Okay, the principle 2, it's actually related to the governance of the liquidity management. The principle 2 is actually related to what? That there must be a proper liquidity risk tolerance policy over there. So there must be particular tolerance limits related to the bank strategy, that what tolerance limits can be there which the bank can actually be working upon as per the appetite of the bank. Now let's say the case that if the bank can work in the lower liquidity environment and the bank is habitual to the same, in that particular case the liquidity tolerance limits must be fixed in such manner. Okay, but if the bank is actually needs a very high liquidity, the tolerance limits must be fixed in that particular scenario over there. Okay, so that's the case related to principle 2. And the principle 3, it says what? It says that the senior management must be involved. They must be involved and they must be developing a strategy, they must be developing the policies, they must be having the practices with them, so that they can manage the liquidity risk in accordance with the risk tolerances. Now risk tolerances were set up by the board of directors over there, and in particular accordance with the risk tolerances, the senior management must be having the strategies, policies and the practices, so that they can actually be working upon those tolerance levels over there. And all the information must be reviewed continuously over there, and that must be reported to the board of directors. Okay, so it's particularly related to senior management is there. Senior management must be having the strategies, policies, etc., so as to they can actually be working in accordance with the tolerance limits over there which are set by the board of directors. And particular reporting must be done to the board of directors over there, and board of directors must be reviewing the strategies, that whatsoever the strategies, policies, procedures were fixed up, set up by the senior management over there, those will be reviewed by the board of directors over there. Okay, so that's the case related to it. And the principle 4, it's related to the costs over there. Now there is a process related to internal pricing. Internal pricing is related to what? That when one department is working with the other, what is the cost related to the same? Okay. Now in the process of internal pricing, the bank must be incorporating the cost related to liquidity, the benefits related to liquidity, and the risks related to liquidity, so that the ultimate performance can be measured. And further, also in the new product approval process, this internal costing must be taken into account over there. Okay. Then further, it's related to measurement management of the liquidity risk over there. Principle 5 is actually related to what? That the bank must be having a sound process. The sound process must be related to what? Related to identifying the liquidity risk, quantifying the liquidity risk, monitoring the liquidity risk, and controlling the liquidity risk over there. That's actually related to IMMC. Okay. IMMC is related to what? The identifying, measuring, monitoring, and further controlling the liquidity risk over there. Okay. And the sixth principle is actually related to what? That the bank must be actively monitoring and controlling the liquidity risk exposure. Now whatever the liquidity risk exposure is there, let's say the case there is a liquidity risk exposure over there. So this liquidity risk exposure must be actively monitored and actually be particularly controlled over there. We must be looking for what are the funding needs, that if this particular risk will surface, what would be the funding needs over there that's actually related to it, and what can be the legal causes, what can be the other risks which can be faced by the bank over there. So those all things must be looked into. Okay. And the principle 7, it's related to the funding strategy, that what is my funding strategy. Now let's say the case that the funding risk is there, and definitely that will be there. Okay. That cannot be ultimately be mitigated at all. Okay. So the risk will be there. So I must be having a proper funding strategy, that from where my funds will be arising, and how I'll be funding the situations. Okay. So I must be having the funding strategy, so that I must be having effective diversification of the assets or the deposits, so that I can meet up the liquidity stresses over there. And particularly I must be supervising the thing that what is the capacity in case of the failure to manage the liquidity risk, what is my capacity so as to particularly raise the funds quickly from those sources over there. Okay. That's the principle 7. And the principle 8, it's actually related to Principle 8 is actually related to managing the intraday positions. Now, in the case of intraday, in a single day, whatsoever the payment obligations, whatsoever the settlement obligations, whatsoever the assets, those are going to mature and you're going to have the inflows, you have to manage them all effectively. Both under the normal as well as under the stressed conditions over there. Okay. Then further, it's related to principle 9 over there, that we must be particularly be managing our collateral positions actively. That must be managed. Then what are the collaterals that we are having right now, based upon what we can actually be raising the liquidity in future. Okay. The principle 10 is actually related to what? That we must be conducting the stress test on the regular basis. Now, what is a stress test? It's particularly related to if this particular condition will be there, then what will be our liquidity requirement? Then what will be the liquidity requirement over there, and how we are going to actually manage the funds over there, how we are going to deal with it, and those stress tests must be conducted on regular basis. And further, the current exposures must be taken into account while doing so, and further the bank's liquidity risk tolerance must be set up as per those stress tests over there. Okay, so that's the case related to principle 10. The principle 11 is actually related to the CFP, that's actually related to the contingency funding plan over there. Now, if there is a contingency situation, what will be our funding plan in that particular case, how we are going to manage our liquidity risks over there in that particular case, that's actually related to principle 11. Principle 12 is actually related to maintaining a cushion, that you must be having some unencumbered high quality liquid assets with you, so that will actually be acting as the insurance. Okay, so even if under the stress condition, when there is a severe liquidity stress is there, if you are having unencumbered liquid assets, high quality liquidity assets with you, definitely you can actually gear up and further can come out that particular situation over there. Okay. The last but not the least, it's actually related to public disclosures. Now, the principle 13 is actually related to public disclosures, that the disclosure information related to liquidity, that information must be available in the market, which actually be enabling the market participants so as to make a informed judgment. Okay, because if the bank is out of liquidity, the bank is not going to be solvent over there, definitely that's a particular thing that the depositors and the particular participants must be knowing about. Okay, so that the public disclosures must be there, and they're on the regular basis it should be. Then further, it's related to the governance of the liquidity risk management over there. So first of all, it's related to board of directors. So the overall responsibility is actually with the board of directors, that they are to manage the overall risk over there. They actually do decide the strategy. They are going to review the strategy, procedures, policies which are actually being fixed by the senior management over there. I already told you related to this. And further, they actually need to ensure that they do understand the nature of the liquidity risk that is actually there in the bank over there, including the liquidity risk profile related to branches, subsidiaries, and for the associates, and also on the aggregate level the risk must be known to them. And the second factor, the second tier, it's related to the risk management committee. It actually reports to the board of directors over there, and it consists of the CEO, CFO, chairman, and the managing directors over there, and whatsoever the heads of the credit, liquidity, and credit market and the operational risk management committee over there. Those are the members of the risk management committee, and further they will be reporting to whom? They will be reporting to the board of directors over there, and they actually do evaluate the overall risk. Whatsoever the overall risk, or say the liquidity risk is faced by the bank, that is actually evaluated by the risk management committee over there, that is the RMC over there. Then the third one, it's related to the ALCO, that is the asset liability management committee over there. So it will be consisting the top management of the bank over there, and will be responsible related to what? So as to basically ensure that whatsoever the policies, procedures, risk limits, tolerance levels are there, we are adhering to the same. And further, if there is any divergence, that must be reported. And further, they need to actually implement the liquidity risk management strategy of the bank over there. Then the fourth one, it's related to ALM support group. That's actually the asset liability management support group over there, and it will be basically be consisting of the operating staff. So first of all, we are having the board of directors over there, and after that we are having the risk management committee. After the board of directors, we are having the risk management committee over there, which will be reporting to the board of directors over there. And then we are having the ALCO, that is a asset liability management committee. Asset liability management committee over there. This particular ALCO will be doing what? This ALCO will be ensuring that we are actually be adhering to the rules, regulation, tolerance limits, etc. And further, then we are having the ALM support group. We are having the ALM support group over there, which actually be consisting of the operational staff, which will be responsible so as analyzing, reporting, monitoring the liquidity risk profile to the ALCO over there. They will be reporting to ALCO, and further this is the task related to it. So they will be forecasting the simulation results and whatsoever the recommended actions that is to be taken, because they're actually working on the ground level. They do know what kind of things are working out over there or not, and they will be reporting to the ALCO over there. Then further, it's related to the liquidity risk tolerance over there, quite important topic. So bank, I already told you that the board of directors is having the ultimate responsibility, and they will be setting up the risk limits and tolerances over there. The risk limit and the tolerance levels over there, those are to be set up by the board of directors over there. And further, these must be explicitly defined in the policy. These must be explicitly defined in the policy. These must be expressed in the policy over there, that what is actually the tolerance limit and how the bank will be working over the same, and bank must be adhering to the same. The bank must be adhering to the same, and that is a task associated with what? That is a task associated with the asset liability management committee over there, with the ALCO over there. Okay, so that's the case related to it. And further, the risk tolerance limits must be specified, must be fixed in such a manner that it must be taking into account the overall bank risk factor over there, and it must be also be particularly specified in terms of the minimum survival horizons over there. Let's take the case that whatsoever the minimum horizon levels which are actually particularly given over there. Let's take the case we are talking about the time horizon limit for 2 to 7 days, or from 8 to 15 days over there. Now in these time horizons, this particular liquidity risk must, this particular liquidity must be maintained, so that must also be specified. Okay, so that must also be specified. And whatsoever assumptions which are actually taken while actually keeping up or while setting up these tolerance limits and tolerance factors over there, those particular assumptions must be reviewed at least within 1 year by the board of directors over there. Okay, so that's the case related to it. And further, it's related to the management of liquidity risk. So we are having the different steps related to it. First of all, we are having the identification that we must be identifying. So whatsoever the procedures, processes are there, or off balance sheet operations are there, we must be looking into each and everything over there, so as to identify that what type of liquidity risk is there and what is the exposure factor related to the same. And even if it is a case of the embedded option, we must be looking for this liquidity risk if it is present. Okay, then the second one is related to quantifying the liquidity risk. Now it's quite important, so as to quantify the amount of liquidity risk which can be there, and there are two simple ways which are actually actually present, by virtue of which we can actually be measuring the liquidity risk. First of all, it's related to the stock approach, and the second one, it's related to the flow approach. Okay, now first of all, we will be learning about the stock approach over here. So as the name suggests, under the stock approach, first of all, we will be evaluating the stock of liquidity, that what is the stock of liquidity we are having. And under this method, we will be actually be calculating the different ratios, like we'll be going for the liquid assets to the short-term liabilities over there, or we will be going for the core deposits to the total assets ratio over there, or loan to deposit ratio, etc. So these particular ratios, different ratios will be calculated, and further these will be compared to the benchmark ratios which are actually set up by the bank itself. Okay, so that's the case related to the stock approach. So that's actually the related the thing over there. And further, in this particular case, there is actually not requirement related to the intrinsic liquidity risk profile of the bank. So that's not actually required, because we are just going to we are actually going to compare the ratios with the benchmark ratios over there. So it's actually the indicator of the past action. Okay, because the ratios will be actually be depending on the past data, because whatsoever the past data you are having, depending on the data, you will be calculating the ratios, and you're going to compare those ratios with the benchmarks over there, and you're going to say that you are having the sufficient liquidity with you or not. Okay, so that's actually related to the stock approach. Now, what are the different ratios that we do calculate in the case of the stock approach? Let's have a look at it. But before that, we'll be looking at the factor related to the flow approach. Okay, now under the flow approach, we'll be forecasting the liquidity positions at the different points of time. Okay, now we'll be actually be forecasting that this is the liquidity position at some particular time horizon, and this is the liquidity position L2 at some particular different time horizons over there. So we'll be actually be looking for the liquidity requirement. We will be forecasting what will be the liquidity requirement. Let's take the case, we are going to say that for overnight our liquidity requirement is 12 crore, and for 2 to 14 days we are having the liquidity requirement of 100 crore, and so on. Okay, so that's actually related to what? That's actually related to that today we are having the liquidity requirement this much, tomorrow we'll be having liquidity requirement that much, and there are after and the next 7 days to 14 days we'll be having requirements up to that much. Okay, so we actually divide the time into different time buckets. We actually name them different time buckets over there, like for 1 day, for 2 to 7 days, or 2 to 6 days, then 7 to 14 days. So these are the different time buckets which are actually decided as per the advisory given by the Reserve Bank of India, and particular over the different time series over there, we'll be looking for what was the liquidity requirement under some particular time bucket over there, and if even if the bank is maintaining that particular liquidity with the bank itself or not. Okay, so that's actually will be the judgment factor related to if the bank is having the sufficient liquidity or not. Okay, so that's the case related to it. And further, it's related to the liquidity risk management, the different ratios we are going to basically read about. So first of all, it's related to the ratio that's actually related to what? That's actually related to volatile liabilities minus the temporary assets. Volatile liabilities minus the temporary assets, and divided by earning assets minus the temporary assets. Okay, now what do you mean by the temporary assets? The temporary assets are those assets which are not going to stay with you for a longer period, for more than 1 year, like you're having the cash, excess CRR balances with the Reserve Bank of India, or you're having the bank balances with the other banks over there, or the bill discounted or purchased up to 1 year over there, or the investments that you have made for 1 year, or swap funds up to 1 year. Those all are the temporary assets. Okay, now what was the formula? The formula was related to the volatile liabilities, the liabilities which are volatile, the liabilities which are volatile over there. Definitely those volatile liabilities may actually be maturing beforehand. Okay, and minus the temporary assets divided by the earning assets minus the temporary assets, again that is actually the ratio we are concerned about, and the industry average for the same is 40% in this particular scenario. So it particularly measures that the extent up to which the volatile part, the volatile money supports the earning assets of the bank over there. So more it is, better it is. So more it is, better it is. That is actually the some risk of illiquidity over there. Okay, and further the second one is related to core deposits divided by the total assets. Now what do you mean by the core deposits? What do you mean by the core deposits? So all of the deposits which are under the CASA, that is the current account and saving account, above 1 year, as reported under the structural liquidity statement over there. That's actually the statement volatility close over there. We have already done the case studies based upon that, so you can learn the things related to the concepts from there. So let me just tell you over here that under the different volatility, so you don't actually consider 100% part of the current assets or the saving fund assets to be volatile. Okay, so we are talking about the non-volatile part over there, the part of the CASA which is above 1 year as per the structural liquidity statement over there, plus net worth, those are the core assets over there. So the total assets divided by the total core assets divided by the total assets, that's actually related to the ratio we are concerned about, and it actually tells us the extent that it tells us that the assets which are funded through the stable deposit base, because the core deposits are the stable assets over there, and for the stable base is told about it tells about that what part of the total assets is funded from the stable funding base over there. Okay, and the industry average for the same is 50%. The third one is related to the loans plus the statutory liquidity ratio plus the CRR plus the fixed assets over there divided by the total assets. Now if you look about the basically numerator part over there, it's actually the least liquid part over there. It's the least liquid part over there, because the SLR that you are maintaining, that is not liquid, because you cannot take the liquidity. The CRR you are maintaining is not liquid. The fixed assets you are having are not liquid. The loans you are having given, okay, so that's not actually that much liquid now, because you will be receiving the repayment over that particular time domain over there. Okay, so these are the least liquid. The numerator is least liquid. Okay, and it particularly signifies what? It particularly signifies the degree of illiquidity embedded in the total deposits. That we are having this particular total illiquid assets from the total assets over there. Okay, so these are the total illiquid assets embedded into the balance sheet over there. So that's the ratio particularly related to it, and the industry average to this ratio is 80%. Okay, then further it's related to loans, SLR, CRR, FA2 core deposits over there. That particular how much illiquid assets are financed out of the core deposits, because of these are the stable funding base. The core deposits are the stable funding base over there. So what part of the illiquid assets is actually financed from the stable funding base over there? That's this particular ratio signifies, and the industry average for this is 150% in this particular scenario. And further it's related to the temporary assets to the total assets. So it is temporary assets to the total assets over there. Now temporary assets is actually related to what? That the liquid assets that you are having right now. So it actually tells about the ratio of the liquid asset you are having from the total assets over there. And definitely the larger ratio is also not particularly good over there, because if you are having a very higher number of the liquid assets with you, that means you are not utilizing those assets over there, and it's actually unnecessary cost that you are bearing. So that's actually not required. So the industry average is kept to 40% in this particular scenario. Then it's temporary assets to the volatile liabilities. Now, what do you mean volatile liability? Volatile liability that may arise right now, that may arise within a day, within a week, within a month, or within a year. Okay, so that's actually what? That's actually the volatile liability over there. And temporary assets, the assets which are actually the liquid assets over there. So definitely, if this ratio is 1 or above, that's actually good. But if this ratio is lesser than 1, that is not required at all. But industry average related to the same is 60%. Okay, and further it's related to volatile liabilities to the total assets. Now, what part of the total volatile liabilities comes from the total assets over there? The extent of the volatile liabilities from the fund of the balance sheet over there, that's actually the thing related to it, and the industry average is to be kept at 60% over there. Now, how you can memorize these all? First of all, you must be looking for the numerator and the denominator, the factors you must be considering, and you must be not be cramming them all, and then go for that what ratio must be higher and what ratio must be lesser. Like in the case of the core deposits to the stable to the total assets over there, core deposit is actually the stable funding base over there. So what is the percentage of the stable funding base from the total assets? So higher it is, better it is. Okay, so you must be remembering in such a scenario, such a manner over there, and not be cramming it. Okay, so just go through the same once again, and you can actually be memorizing the same. Okay, so the notes are available, so you can just go through the same. Then further it's related to the volatile liabilities. Volatile liability, the liabilities which are going to be payable in just coming 1 year. So that's actually the volatile liability. Like we're having the deposits plus borrowings plus bills payable up to 1 year, or letter of credit full outstandings over there, or component of the credit conversion factors over there. Like in the case of the contingent or the off balance sheet exposures, you have to convert them into the credit factor. That what is a credit exposure related to them. Okay, so these are the contingent liabilities. So if we are convert this to the credit exposure into it, okay, so we can be using the CCF, that is a credit conversion factor over there, so as to convert the contingent liabilities into the credit liabilities over there, and further that's actually the volatile part over there. Then further it's related to temporary assets. I already told you the earning assets is actually related to what, it's actually related to the total assets that you are having, and whatsoever the balances that you're not earning any kind of interest, like on the fixed assets you're not earning any interest, balances in the current account with the other banks you're not earning any interest. So other assets which are excluding the leasing over there or intangible assets over there, you are earning no interest. So those are the non-earning assets. So when we'll be subtracting the non-earning assets from the total assets, that will give us the earning assets over there. Okay, so that's a case related to it. And further it's related to the stress testing. So stress testing, I've already told you, stress testing is actually related to the criteria, related to the assumptions that we have made, that we must be having these assumptions, and further under these conditions, what will be the impact on the funding requirements, what will be the impact on our liquidity positions over there, and how the bank will be tackling with the same. So that's why the stress testing must be made an integral part of the overall governance of the liquidity risk management system over there. And further the bank must be conducting the stress testing on a regular basis over there. So that's the case related to it. And whatsoever the results of the stress testing are there, those must be discussed thoroughly with the asset liability management committee over there, so that the remedial and mitigating actions can be taken in time. Then they must be taken in time, and further they can be identified, and for the proper report must be maintained, proper documentation must be there, all the things must be documented, either the results, either the remedial actions, those all must be documented well, and those must be available for the scrutiny by the Reserve Bank of India or the inspecting officers whensoever required. Okay, so that's the case related to it. And moreover, if there is any vulnerability, like we basically did the stress testing and we found the vulnerability, those all must be looked into, those must be indicated, and further those must be reported to the board of directors, so that the required action can be initiated in time over there. And further also those must be reported to the Department of the banking supervision. Through the Department of the Banking Supervision, those must also be reported to the same, that is the Central Office of the Reserve Bank of India. Those must be effectively informed about the same. Okay, so that's the case related to it. Then further it's related to CFP, that is a contingency funding plan. Contingency funding plan means what? It's particularly related to that there is a contingency, there is a stress situation, and further what is our plan, that from where the funds will come, and what is the position liquid to our liquid assets. That take the case that we are having the liquid assets, and we must be in a position that we can convert those liquid assets into the liquidity over there. So that's actually the CFP over there. So that's actually related to the severe disruption of time, so that we can actually be looking for the particular remedial actions that can be taken in time, so that we can actually be dealing with the liquidity risk position over there. And further the liquidity risk management CFP plan must be commensurating to the risk profile, to the complexity of the bank, to the scope of the functions which are being performed by the bank over there. And these contingency plans must be tested regularly, so that we can check that if these CFP plans are effective enough or not. And further, if we found any kind of deficiency, that must be looked into, that must be reviewed by the board of directors over there, and particularly the required things must be placed over there. Okay, so that's actually related to CFP over there. Further, it's related to the overseas operations of the Indian banks branches, subsidiaries, and branches of the foreign banks in India over there. Now, what's the operations which are being particularly held by the Indian banks in the foreign countries over there, or the branches or subsidiaries outside overseas, or the foreign branches which are operating over here in India? In that particular case also, so in any of those cases, the branches should not be considering the volatility risk exposures exceeding 10 years over there. So whatever the liquidity risk exposure is there, that must not be considering the factor related to if those are exceeding 10 years. Okay, so that's the first case. And further, the long-term resources base must be broadened. Okay, like if we are basically depending on the short-term resources, funding sources, that can be there, but long-term resilience must be actually be broader. Long-term funding base must be broadened over there. So that's the case related to it. And further, we must be limiting the mismatches. Like I already told you that in the structural liquidity management over there, we actually having the different buckets over there. Like we are having the bucket size for 1 day, and for 2 to 7 days, from 8 to 15 days, and so on. Okay, and now in this particular case, the mismatch related to the different time horizons, those that must be limited. And there are conditions for the same. Like where for the long-term sources, this should not be falling below 70% of the long-term assets. So what's the long-term assets amount over there? Let's say the case we are having the long-term assets amounting 100 crore. In that particular case, the long-term sources of the funds should not be lower than the 70%. That should not be lesser than 70 crores over there. Okay, so that's the case related to it. And also for the long and medium-term resources together, they should not be falling 80% of the aggregate of long and medium-term assets over there. So for long-term assets, it is actually 70% of the long-term sources, and for the long-term and medium-term resources together, they should not be falling below the 80% of the long-term and medium-term assets over there. So if we are having the long-term assets of 100 crore, the resources should not be below 70 crore. If we are having the long-term and medium-term combinedly 100 crore, the long-term resources should not be falling below the 80 crore over there. Okay, so that's the long-term and medium-term combinedly should not be falling below the 80 crore over there. So that's the case related to it. And the control that must be taken currency wise for each of the currency which we are maintaining, 10% or more. Let's say the case that if the bank is maintaining different currencies over there, and if single currency is actually be constituting 10% or more of the total currencies in the bank over there, in that particular case the currency wise position is to be maintained by the bank over there, and netting of the intercurrency is not actually allowed. So whatever the intercurrency positions are being maintained, the netting of the position is actually not allowed, and maturity gap is not allowed over there. And for this particular purpose, we can say what is short term, what is long term, medium term over there. Let's have a look at it. So short term is particularly related to those particular assets which are going to mature in the next 6 months over there, and for the period greater than 6 months and up to 3 years, it is actually the medium term, and the period 3 years or more is actually it's a long term period over there. Okay, so when we are considering the long term assets or long term resources or medium term sources, medium term assets over there, so this is the definition related to the same. The question can be asked from this particular point over here. Okay, then further it's related to ID, that is the international department over there. Now whatsoever the monitoring system is there, because the bank must be monitoring the liquidity position. In case of overseas banks or foreign banks, the branches who are having the branches in India over there we are talking about, so whatsoever the monitoring related to liquidity risk management, that must be done by the international division of the bank over there, which must be controlling the mismatch under the different time horizons over there. That must be looked into at a consolidated level, on the subsidiary level, or combinedly also. Okay, and also that must be maintained currency wise. I already told you, if the currency composition is 10% or more for single currency, in that particular case currency wise positions are to be maintained. Okay, so that must also be looked into. Further, it's related to management information system. Now, what is actually the management information system? The MIS is actually related to the information so that it can be provided at the different levels. First of all, we are having the position related to liquidity. That what is a liquidity level, what different type of liquidity levels to be maintained, what are the different funding positions which are there, and the different encumbered we can say assets over there, or we can say the collaterals that we are having right now. Related to all this position, that all positions or all information must be there in one particular system over there. And also related to market data, related to what is the impact of market position on the liquidity of the bank over there. Those all things must be maintained in the MIS over there, that is a management information system over there. And particularly all particular things must be captured by the same, and further those must be reported at the different levels of the organization over there. And this particular sufficient detail must be available with the management, so that management can take the informed decision, and particularly they can look into the sensitivity of the assets over there. And further, if they want to make some changes to the composition of the assets over there, composition of funding requirements over there, that can be made by them depending on the different conditions over there. Okay, that's actually related to the MIS. Further, it's related to reporting to the Reserve Bank of India. So whensoever bank is managing the liquidity risk, that is actually also to be reported to the Reserve Bank of India. And further, there is a particular reporting criteria related to the same, and as per that particular reporting criteria, that must actually be reported to the Reserve Bank of India. And further, it must be as per the prescribed format, and that must be forwarded to the Chief General Manager in charge, who is actually Chief General Manager in charge of the Department of Banking Supervision, central office of the Reserve Bank of India. And further, that must be forwarded to the same. And then it's related to the statement of structural liquidity over there. So we are having the different buckets over there, like the liquidity requirement for next day, 2 to 7 days, 8 to 14 days, 15 to 30 days, 31 to 2 months, greater than 2 months to 3 months, 3 months to 6 months, 6 months to 1 year, 1 year to 3 year, 3 to 5 year, and more than 5 years. Okay, so we're having the different liquidity requirements for the different buckets over there. And for single liquidity bucket, we'll be looking for the mismatch over there, liquidity mismatch over there, like what are the cash inflows, what are the cash outflows for particular time horizons over there. And then we'll be looking for what percentage of volatility is actually allowed. Okay, so that's the statement of structural liquidity. Okay, the case studies based upon the same are already covered. Kindly please go through the same. Further, its related to statement is actually required to be reported in 5 parts. What are those 5 parts? First of all, the first 3 reports are to be reported on fortnightly basis, and the last 2 reports are to be reported on monthly and quarterly basis over there. Okay, so first report is actually related to for domestic currency and Indian operations. Whatsoever the Indian operations are there, whatsoever the domestic currency is there, that is to be reported on fortnightly basis. For foreign currency and the Indian operations, so foreign currency and Indian operations, that is also to be reported fortnightly basis. And combined Indian operations, like foreign operations as well as Indian operations, that is actually to be reported fortnightly basis. And also for overseas operations, that is actually to be reported on monthly and quarterly basis. And consolidated bank operations, like overseas operations as well as the Indian operations, also in foreign currency, also in domestic currency. Okay, so those must be reported on monthly and quarterly basis over there. Okay, so I have already told you that statements 1, 2, 3 are particularly required to be submitted on fortnightly basis, whereas statement 3, 4th and 5th are to be reported on monthly and particular quarterly basis over there. And further, the reporting dates for fortnightly basis, it will be 15th and 15th and last of the month over there, in case if there is requirement to be submitting the report on fortnightly basis over there. And further, if it's a holiday, then the previous banking day would be the reporting day. And further, in case the reporting is to be done on the monthly or quarterly basis, it will be the last day of the month or quarter over there. Then further, it's related to internal control. What do you mean by internal control? Internal control is actually related to what? That you must be having processes, you must be having the procedures, you must be having the systems with you, so that you can ensure that whatsoever the guidelines, whatsoever the policies, whatsoever the procedures related to which are affixed by the top management, by the board of directors over there, those are adhered or not. Okay, so banks management must be ensuring that there must be some independent party who will actually be regularly reviewing that the policies are being meant with or being adhered to. And further, the various components of the bank must be actually maintained, and for the proper documentation must be done, and a review must be done. And whensoever the information is required by the inspecting officer, that information must be provided to the inspecting officer over there. So that's actually related to internal controls, and that will be all related to the liquidity risk management over there. I hope that you must have understood the concepts related to liquidity risk management.